Database specialist MongoDB reported earnings after the market closed today, and shares were up to almost $420 per share. They've since tempered down up about 5%. So what did the company announce during the quarter? Let's spend the next 10 minutes trying to figure that out. My name is Brian Stoffel, and at the time of this recording, I do own shares of MongoDB. Want to thank YCharts for sponsoring today's video. More from them in just a minute. So let's look at the company's second fiscal quarter of 2024. That's right, 2024. They have an odd quarter that ends at the end of July. If we look at the company's top line growth, it was excellent. 40% growth on the top line. Revenue coming in at $423 million. That was well ahead of Wall Street's estimates and management's own guidance. Same story on the bottom line. While this is on an adjusted basis, which means that it does not include stock-based compensation, earnings per share of 95 cents per share was double pretty much what Wall Street and management were projecting for. We'll get to why that was the case in just a minute. Let's look at margins. On the whole, this was incredibly encouraging. All of these on a non-GAAP basis. Gross margins expanded. That's very important. But look at operating and net margins. With both went from a loss to a gain during the current quarter. Now, free cash flow, on the other hand, is still negative, although those losses are narrowing. Net income on a non-GAAP basis swung from a loss to a gain. The balance sheet remains in healthy shape, not stellar, but very healthy shape with a net cash position of almost $800 million. Let's dig in a little bit more to what happened. One thing to make note of is you see that free cash flow is still negative, and you don't normally see that with companies like MongoDB. The reason that was the case is that the company decided that instead of getting customers to commit to lots of spending on upfront, they decided to let them pay as you go. And they believe that those customers will find these solutions so helpful with their workloads that they will up their payments to MongoDB because it's a usage-based tool over time. In a way, and this is a very crude example, it's like a drug dealer giving the first bit for free and knowing that that customer will be hooked for life. Again, a crude example, but it lets you know why MongoDB is willing to not have all that payment up front, and it's also why free cash flow might not be as positive as you see with other companies. But let's move on with the rest of the quarter. Management said that Atlas showed 38% growth year over year, and it now accounts for 63% of total revenue. It is also worth mentioning that there was really strong performance from Enterprise Advanced, which is separate from Atlas, which is self-service. Enterprise Advanced is more MongoDB doing some of the work for you. Management did not expect this strong performance to continue indefinitely. It was more of a one-time thing, and it is what accounted for most of the outperformance in terms of revenue during the quarter. Now, if we continue moving on, what we'll see, is that total customers were up 22% to about 45,000. Direct sales customers were up about 26%. Those using MongoDB, which is largely self-service, was also up significantly to about 43,500. And this is important. The number of customers that are paying MongoDB at least $100,000 per year was up 27%, in acceleration from 2 quarters ago to 1,855. What about stock-based compensation? Because we saw that those non-GAAP numbers were significantly better than GAAP numbers. Well, the company paid out $113 million in stock-based compensation. That's equivalent to about 27% of revenue. That is a lot. One of the good things is that because the stock is so richly valued, that was quote unquote only 3.7% dilution. That is higher than we like to see on an absolute basis, but this is a company that is really hitting all of its notes. So if we're going to make an exception in any case, this is probably the case where we're going to do that. Now, if we turn to guidance, management guided for 20% growth on the top line. That's well ahead of Wall Street's estimates. It also guided for non-GAAP earnings to more than double, well ahead of Wall Street's estimates. And if we look at the full year, management previously said that they would have 19% growth on the top line, 84% on the bottom line, and both of those were below Wall Street's estimates. However, after today's earnings, they revised that upwards, and they importantly revised it upwards on an absolute basis more than their beat for this quarter. They now believe revenue will grow 25% per year, meaning that it will accelerate from where it was before, and that earnings per share on a non-GAAP basis, look, this company is flexing its at least non-GAAP operating muscles, should almost triple for the year to $2.31 per share. So what should customers watch moving forward? Well, first, keep an eye on total customers. Winning over those customers and their workloads is important. Number two, Atlas revenue. Although, truth be told, Enterprise Advanced could become more important as we move on. That's less of a self-service option. Number three, keep an eye on those operating margins. They expanded meaningfully, and that is great. Number four, keep an eye on free cash flow. And when I say that, I mean in reference to management's comments about how sometimes they're foregoing those large commitments up front because they know they're going to hook those customers in for the long run. That being said, we still want to see them at least be break even at this point. I have absolutely no doubt that the moat is widening around this company. They are winning workloads, and that is the name of the game for people who are investing in this company looking to hold it for the next 10 years. And the thesis is very much on track. So when I run this through my checklist, it gets an 11. It's been a while since Brian Feroldi has done this, but it got a 76. But next, we do need to look at valuation. And when we look at what stage of growth is the company in, it is solidly in stage 3. So to look at valuation, we'll head on over to YCharts, a tool that Brian Feroldi and I use every day. If you'd like to use this, you can click on the notes in the link below, and you can get a free trial. Mention Brian Feroldi's name, and you'll get 20% off your subscription. So if we head over there and we look at MongoDB's price to sales ratio, it's 19 right now. And look, in no world is that considered cheap. In fact, it is very expensive on an absolute basis. I will say that it's roughly par for the course for where MongoDB has been for most of its life as a publicly traded company, the last 6 months notwithstanding. We could also look at it on a price to free cash flow ratio, but you know what? This is nosebleed territory, so get ready, because it's trading before today at about 1,100 times free cash flow. After today, about 627, which looks so much better, but is again absolutely ridiculous on an absolute basis. I would not read that much into it because this is a company that is not optimized for free cash flow. In fact, there are other ways of looking at this, and a power multiple calculation might actually be the most useful. And to do that, we can use a tool that Brian Feroldi, Brian Withers, and I have built, where we go over here and we type in our ticker, MDB, and it will auto-populate from MongoDB. Now, I'm going to fill in the numbers. I'm going to fill in the numbers for MongoDB, and what I'm going to do is say that I know that after today their revenue was about $1.5 billion, so I'm going to input that. And look, right now the free cash flow margin is just 3%. And look, there's no way that it's going to stay at 3%. It could get up to 20, and if it gets to 20%, we can look right here, and we see that if it reaches that level, well, then it's trading for still a fairly high ratio of roughly 90 times free cash flow. What if it hits 25% free cash flow or earnings margin? Well, then that dips it down to about 72 times trailing free cash flow. What if it could even hit 30%? That might be a stretch, but it could. And if it does, that would still be 60 times free cash flow. So in no world would this be considered cheap. So when I go back to look at it, I have to say to myself, well, how reasonable is this assumed growth rate? And I would say I would put it here. It's not favorable by any stretch of the imagination, which would mean that my score would bump down to a 10.5. And some of you might be wondering, well, why are you only bumping it down that much? Well, look, the runway for MongoDB is huge, and I think that their decision to forego free cash flow now to win over those workloads is incredibly important. And I actually believe that this company could continue growing at very high rates for a very long time because it's usage based. That means it can slow down faster than most, but over the long haul, for long-term investors, I still think that it is worth owning shares of this company. It is one of my highest allocated companies in my portfolio, and I intend to keep it it that way moving forward. That said, you might not agree, and that's okay. Now, if you want to use that power earnings multiple sheet that I showed, you can click on the link in the show notes below. But let me know what you thought of MongoDB's quarter. We'll check back in this one in about 90 days. And until then, Brian, out.